Um, Welcome to the latest in our series of private client webinars. I'm James Kipping, a tax partner at MHA, and I'm joined today by Marcus Bull of MHA Caves Wealth. Today, we will be talking about family investment companies and trusts. It's not necessarily a choice of using one or the other, as the title of the webinar might suggest, because actually they can work well together in certain circumstances. But hopefully we can give you enough information to help you understand how they can both be used in your tax and wealth planning. We'll talk for about 40 minutes or so, hopefully leaving plenty of time for questions at the end. I will start off talking mainly about family investment companies before handing over to Marcus to discuss how trusts can be used in wealth planning. And I've set out here broadly what will be covered today. So I'll explain what a family investment company, or FIC as I will refer to them throughout as, what their key features are, how they're taxed, hopefully highlighting the key potential tax advantages. I'll look at a typical but quite straightforward structure, and then some tax traps, as I've called them there at number 5, just that we must be aware of when structuring a FIC and how to extract value from them. I'll introduce trusts as an alternative, but at that point, rather than risk any overlap with Marcus, I'll hand over and he'll provide much more detail about how they can be used in estate planning alongside the types of investments that might be used in a trust structure. So, without further ado, what is a family investment company? Well, in simple terms, it's a company whose shareholders are family members. Now, they can be structured to replicate many of the features of a trust, but without the restrictions and complexity imposed by what we call the relevant property inheritance tax regime. So they've become commonplace since the changes to the trust regime back in 2006. They typically enable parents, for example, to retain control over assets while accumulating wealth in a tax-efficient manner and facilitating future succession planning. So inheritance tax planning is usually a major reason why they're put in place. And although not set out on the slide here, broadly the inheritance tax advantages are typically gained by one or more of the following three things. So splitting the shareholdings across family members provides an advantage in that there's often a gift of capital when the company is established. Okay, so that gift of capital then falls out of the donor's estate, but the shareholdings of the company can be structured in such a way that the donor might, let's say, retain control or a large degree of control over the company. Those split shareholdings present an opportunity for discounts to be applied when valuing a particular shareholding. For example, if they're being valued on death. For example, a 50% shareholding might enjoy a valuation discount of, say, 20% from half of the proportionate value of the company. And as I said when I began this slide, FICs are outside the relevant property regime for inheritance tax. They're not subject to the 10-yearly or exit charges that apply to most trusts. In terms of their key features, well, this isn't an exhaustive list by any means, but I just wanted to highlight a few of the key points, and certainly those things we would be discussing at the outset with clients and when considering how to structure a family investment company. In terms of corporate form, you might think, well, limited company. That's what we know. That's what we go with. But it's actually possible to use an unlimited company rather than the more well-known limited company structure. From a tax perspective, there's not much in the way of difference. And actually, it's not usually a major consideration for people. But an unlimited company can provide greater privacy because accounts do not need to be filed at Companies House. So if that's a concern, we can use an unlimited company. Second point there, funding. This is really key when thinking about how a company is structured from the outset. And of course, there are various ways that a company can be funded. So in a straightforward case where someone is establishing a FIC with cash, which is to be invested, they'll fund the company with a mixture of share capital and debt, or director's loan, as we might call it. Now, funding as debt provides some flexibility because it allows the individual to retain access to that capital and draw against it from the company, potentially out of profits, without income tax implications. Although, of course, the value of the debt remains an asset for inheritance tax purposes. So typically that split between share capital or debt might depend, obviously depends upon the client's circumstances, but it might be that they need to retain a certain amount of capital for their, or access to capital for their own lifestyle or reasons or what have you, but and use a certain amount to be subscribed in share capital, which arguably might be given away to children, with which they're essentially doing their inheritance tax planning by making that gift of share capital. FICs can also be established with existing assets, and we often advise on how property businesses can be incorporated, for example. In that case, a company is typically funded by it purchasing the assets, in which case there'll be, or maybe, capital gains tax or stamp duty land tax implications, although sometimes incorporation reliefs can apply to prevent some or possibly all of those tax charges. If looking to incorporate an existing investment business, it's significantly more complex and much more difficult to achieve the same level of planning or tax mitigation or inheritance tax mitigation as might be the case if creating a company with cash. I'm not going to focus on, for example, incorporating property businesses or such like today, because it's something that you could talk about for 2 or 3 hours, or rather than the sort of 40 minutes or so that we've got. In terms of share capital, the third point there, FICs can be established with different types of shares, each with different rights attached. So as an example, we might have a company with ordinary shares being held by the parents who have established the company, and ordinary A shares, for example, that are provided to the children. Now, the rights attaching to those shares might be such that the ordinary shares have control, but both classes of share have a right to a dividend at the discretion of the board of directors. In this way, of course, ordinary shareholders retain control and access to an income, while value is set aside and or accruing for the children as the ordinary A shareholders. The final point there, in terms of governance, the directors run the company, and the shareholders do not necessarily need to be involved in the day-to-day running, and may in reality have little influence over the affairs of the company. So it might be that we have children or what have you as shareholders, but actually don't have a great deal of influence, if any at all, over the running of the company, depending upon their role in the business, of course, and the rights and proportion of their shares. How are FICs taxed? There's quite a lot of information on the slide here, and I'll try and sort of run through and pick out some key points. But at a high level, if the company goes and makes investments, then it is potentially subject to corporation tax on its income. Now, from April 2023, the main rate of corporation tax is 25%. It's possible that the small profits rate will apply depending on the profitability of the company. I'm not going to go into that today, other than to say the small profits rate will not apply to close investment holding companies, which is basically investment companies that don't invest in land and property or carry on the trade. But whilst the headline rate of corporation tax is 25%, dividend income will usually, or 99 times out of 100, will not incur a corporation tax liability. So, for example, if an investment company has a general investment account receiving dividend income, then that dividend income will not be taxed. It will only be taxed at the point that the directors or shareholders extract it from the company, say as dividend income in their own hands. Companies will pay corporation tax on capital gains at the same corporation tax rate, 25%. Here we just need to watch for the types of investments that the company invests in. Some some investments will fall into what we call the loan relationship regime for corporation tax, such as corporate bonds, for example. And in that situation, the company will actually pay tax on the growth in value during the year, as opposed to the profit made when the investment is sold. So some care needs to be taken in conjunction with taking financial advice around the type of investments that the company makes. And because of the higher corporation tax rate from April 2023, I just make the point that in some cases the use of a company for investments is no longer as compelling as it was when the rate was lower. For example, from now on, it's no longer the case that a sale and reinvestment is cheaper in an investment company than it is personally. In terms of expenses, the company or family investment company can offer some advantages. So interest expenses are tax deductible, and by contrast, an individual cannot obtain relief for interest on loans to acquire a portfolio of shares, for example. In the case of property investment, you might be aware that residential property buy-to-let mortgage interest only achieves a basic rate deduction for income tax purposes. In other words, the interest relief is restricted for individuals. There's no such restriction to companies. Management expenses, again, much more flexibility or ability to deduct costs within a company, as by contrast, individuals cannot obtain relief for the expenses of managing a share portfolio. Distributions of income. There are various ways that income or profits can be distributed from a family investment company, and all I've put on the slide here is the sort of main dividend income tax rates of between 8.75 and 39.35%. Of course, we have the dividend allowance, but that's only now £1,000. That's the amount of dividend income that an individual can receive tax-free in a tax year. That's reducing to just £500 from next April. So, limited scope for that being particularly relevant. I think the point here that I really want to make is, whilst the distribution of profits as income creates an income tax liability, the company does allow individuals to control the amount of taxable income arising so they can better manage their personal tax positions. We might also use alphabet shares to allow for dividends to be paid to some shareholders and not others. Profit might also be extracted by a mixture of salary, dividends, pension contributions, and possibly interest on loans made to the company. So there can, in the right circumstances, be a lot more flexibility in determining the nature of someone's income, the timing of someone's income, and therefore the timing of someone's individual tax liabilities. From an inheritance tax perspective, shareholders will pay, or their estates rather, will pay inheritance tax on the value of their shares. There's no business property relief for investment companies, for example. But as I sort of said, I think at the outset here, one of the key advantages sometimes from an inheritance tax perspective is the fact that shareholdings can qualify potentially for discounts when they're being valued. So, for example, as I think I said, a 50% shareholding might get a 20% valuation discount. Minority holdings potentially significantly more. So what's a sort of typical structure? And rather than sort of just read through, I think, this slide here, I think I'll go straight to my diagram that hopefully is understandable here. And this is just a situation where we've got parents with a couple of £1 million that they want to invest, and they want to invest with a view to doing some inheritance tax planning but retaining control. So here, parents provide funds to the family investment company in the form of either interest-free loans or perhaps subscribing for preference shares or something. Now this doesn't create a transfer of value for inheritance tax purposes. And of course, that loan, if you like, of 2 million can be extracted from the company at a later date tax-free. The parents perhaps also subscribe for voting shares in the company, which give control of the company at shareholder and board level. In this case, I'm just suggesting, I think, that we've got a share capital of £100. Mum and dad have £52 of the share capital in the form of ordinary shares, and the two children are given £48 of the share capital in the form of ordinary A and ordinary B shares, different classes of share, which potentially allow for different rates of dividends to be paid. And I'll come on to later some anti-avoidance rules that just need to be considered in terms of profit extraction in this situation. But you can see that as sort of time might progress with this quite straightforward structure, as value builds up in the family investment company, it is at least partially accruing to the next generation on their 48% of the shares. And at all times, mum and dad have the ability to draw down against the capital that they've loaned to the company initially. Something that's not on the slide here, but what I should mention, is that we often see trusts used in the share structure of a family investment company. And this is the point I made at the outset about how FICs and trusts can be used together in the right circumstances. So, for example, parents might hold shares on a bear trust for children while they're minors. Now, the bear trust is essentially transparent for tax purposes. It's like a tax nothing, I suppose. So the shares are beneficially owned by the children. And in this scenario, parents would need to be comfortable that there is little asset protection once the children reach the age of majority. Discretionary trusts, on the other hand, are used in cases where asset protection is important, or where you're undecided who should benefit and when. For example, a flexible discretionary trust might be useful if you're looking to provide for grandchildren, but you don't know when they're going to arrive, or when more grandchildren might arrive, or which of them you want to benefit and when, etc. Okay. Now, in this case, and I don't want to talk too much about the tax implications of trust because we'll come on to that a bit later, but the parents might subscribe for up to £650,000 of share capital and put that onto the discretionary trust, because amounts up to each of their inheritance tax nil rate bands can be settled onto trust without any immediate tax liability arising. 7 years down the line, that value is out of their estate for inheritance tax and is being obviously looked after for the benefit of the grandchildren, but they as trustees will retain control. If a trust is used in this situation, the parents should be irrevocably excluded from benefiting. Otherwise, the gift is essentially ineffective for inheritance tax purposes. In terms of profit extraction, conscious of time, I'm going to hand over in sort of 5 minutes or so. In terms of profit extraction, this and the next table just provide a bit of a guide as to what the effective tax rate is if all profits of a family investment company are distributed to shareholders. So if we assume non-dividend income and the corporation tax rate of 25%, you can see that the effective, and £100 of income going into the company, you can see that the effective rate is higher than the equivalent, income tax rate. So for a higher rate taxpayer that would pay income tax at either 33.75% for dividend income or 40% for other income, the effective rate here is 50%. So whilst there can still be advantages of a family investment company in the form of, interest deductibility of costs, etc., if someone is looking to extract all profit as income, that may well lead us to advise actually that a investment company might not be the best route. Okay, in terms of dividend income, that's less of an issue, because you can see that because there's no tax at the company level, the effective rates are essentially the same, and the company simply allows the individual to kind of manage their personal tax liabilities. Okay. I mentioned earlier on a couple of anti-avoidance rules that we need to be aware of when creating FICs and extracting profit. Now, firstly, the settlements legislation, which can apply so that income is taxable on the settlor. So in the context of a family investment company, the settlor will likely be those that create the company. But the definition of settlement is wide, and the rules can apply to not only the issue of shares, but also funding arrangements and dividend waivers. So what does this all mean? Well, I suppose it's especially relevant in relation to spouses and minor children. So if income is diverted to your minor children, perhaps as a dividend paid on shares in the company, it will remain taxable on you as the parent, or in this case, settlor. Generally, though, the rules should not apply in relation to adult children or grandchildren, and there's a specific exclusion for spouses where the asset they own is not substantially a right to income. So if the spouse has ordinary shares on which a dividend is paid, that should not normally be caught by the settlements rules, but it might be if the dividend is enhanced by a dividend waiver affected by the other spouse shareholder. Just I suppose the main takeaway here is you can't use a family investment company or indeed a trust to divert income to your minor children, essentially. But the rule should not apply if the arrangements are set up such that adult children or grandchildren can benefit. In terms of gift with reservation, so this is for inheritance tax purposes, where the gift with reservation rules apply, they basically render a gift to be ineffective for inheritance tax. So this means the gifted property remains within the estate of the donor for inheritance tax purposes. So this applies where there's a gift and the property is not enjoyed to the entire exclusion of the donor. So if the parents give away a large equity stake in the company but retain rights to determine income distributions on their retained shares, is that a reservation of benefit? It's thought not, but to be sure, we might consider restricting dividends payable through the Articles of Association, and perhaps ensuring that each class of share has a fixed entitlement to profit. It's just, these things need to be given consideration when looking to structure a family investment company. And on to the final couple of slides here before I hand over to Marcus. We obviously have clients who already have family investment companies and wish to undertake some inheritance tax planning. And there are various options, and in all cases, bespoke advice does need to be taken. Some of the options we'll consider will be gifting shares or an existing shareholder or director loan, but a gift of shares might incur capital gains tax. So, sometimes that can be prohibitive. We might look to gift shares onto a discretionary trust in the similar sort of manner that I set out a moment ago in that example. We might also look to put in place a growth share plan or deferred share plan. I'm not going to go into the detail, but basically that's creating a new class of share which essentially either qualifies for, or rather benefits from future appreciation in value, or becomes of value in years to come, such that today the value of those shares is low, and therefore they can be given away with few tax implications. And the final slide, really just to introduce Marcus's section, is just trusts, although they can be used in conjunction with family investment companies, they're often actually an alternative for many clients. And here I'm just sort of setting out what two main types of trust are in this type of planning. So a bare trust, or sometimes referred to an absolute trust, has the right to income and capital, and the beneficiary may call for both to be remitted into his own name. The beneficiary's asset it's the beneficiary's asset for income tax purposes, and it may be used, as I explained, for holding a minor's shares in a family investment company. Discretionary trust, on the other hand, is more flexible. It gives the trustees considerable powers over how the trust assets are handled. The beneficiaries don't have any automatic right to receive the income and capital, so therefore provides asset protection, control and flexibility, but comes with some restrictions and potential charges from a tax perspective. So sorry for overrunning, and on that note I will hand over to Marcus to continue to the end, or almost to the end. I'll summarise at the end.
Thanks, James. Good morning, everybody. First of all, apologies. I'm suffering with a cold at the moment, so if there's any pauses while I take a glass of water, I'll hope that it won't be too distracting. So if we can move on to the first slide there, James, thanks. So what we're going to look at this point is very high-level overview of trusts. It will consolidate a fair bit of what James has just said, and you'll probably see some overlap in terms of the mechanics of access to funds and how they're deemed for inheritance tax planning as the FIC as well. So just a quick overview of some of the benefits of trusts as a whole. They identify beneficiaries. So from the perspective of wills, they're very targeted to specific beneficiaries. And depending on the type of the trust, there is the ability to change those beneficiaries. Secondly, anybody who's had experience with administrating any probate cases for families or friends will know that that can be quite a lengthy process. A typical probate case can take 6 to 9 months, more complicated, can take significantly longer. So it can create a significant delay in getting assets to beneficiaries. Whereas any assets within a trust can be distributed to beneficiaries bypassing probate. And also, if there is an inheritance tax liability attached to the probate case, bar any specific trustee cash accounts that have been set aside for inheritance tax costs, normally the estate cannot be used to pay that inheritance tax bill. So funds have to be found elsewhere. Whereas if there are funds within a trust, again, it will bypass probate. It can be passed down to the beneficiaries and used to pay any inheritance tax bill. James alluded to the 7-year rule a couple of times in his talk. If you were to gift or put money into trust, either way, it takes 7 years before it's deemed to be outside the estate for inheritance tax purposes. So if we use an example of wanting to provide money for a deposit for children for a house, they might not be at this point in time ready to buy a house, and therefore let's assume that it's going to be 5 years time before the actual gift is made. If it's an outright gift, we've got a delay of 5 years, you make the gift, and then we've got a further 7 years before that money is deemed to be outside the estate. Whereas if that money is put into trust today, it can be distributed from the trust in 5 years' time, but then there is just a 2-year overlap before it's deemed to be outside the estate. So that can speed up the process quite significantly. There are many different types of trusts. We are just going to focus on the two kind of fundamentals of absolute and discretionary today, but the trust can be set up for income, for growth, for vulnerable beneficiaries. So any particular objective can normally be satisfied within the trust arrangement. And the risk of an outright gift as well. If they are young beneficiaries of that gift, then there's always the concern as to how they're going to use that money. If they're going to use it wisely. If they're in a young relationship or newly married, then there's always the concern as to the longevity of the marriage, whether they get divorced and then some of that gift, 50% of that gift could disappear. So having money within a trust will still allow the power to be with the donor, who's a trustee, and they can distribute those funds as and when they see fit and to what amounts. But it's important to bear in mind that if the trusts are for inheritance tax planning purposes, then whether it's a gift or the trust, the donor does lose personal benefit of those funds either way. If we could have the next slide, please, James. So the first form of trust, absolute trust. Under this arrangement, as the name suggests, the terms of the trust are absolute and fixed at outset. So whoever are the beneficiaries are named beneficiaries, and they cannot be altered. And if a beneficiary dies, then their proportion of the trust will then be passed down under the terms of the will. So it is quite restrictive, but on the positive side, there are no charges within the trust. So the assets within the trust can grow free of any charges, and no risk of the IHT charges that we'll look at the next screen. But the tax implications are on the beneficiary when there are any distributions. So the beneficiary then has to pay tax at their highest marginal rate. Next slide, please. So the alternative to that is a flexible trust, and largely this works almost in opposition to the terms of the absolute trust. So under these terms, again, as the name suggests, there's a lot more flexibility. Whoever the beneficiaries are at outset, they can be altered as time goes on. So if they are initially children, then grandchildren can be included at a later date. And if it's the objectives can alter as well. So if the objectives change to then incorporate school fees, then there's potential that distributions can be made out to the grandchildren, and it'll be more tax efficient that way. And it's also useful if the intention is that the trust is going to be there for successive generations, because then flexibility is obviously quite important. But this does incur lifetime charges. So although on the screen it's a bit about face, the first charge that it could be impacted by would be an initial lifetime charge. So again, as James alluded, there is a nil rate band. We all personally have a nil rate band of 325,000. So there wouldn't be a tax charge on that. But if there was excess added to the trust over and above 325,000, then there would be an immediate tax charge of 20%. And then every 10 years, there is a periodic charge, which could be up to 6% of anything above the 325,000. So that obviously does impinge on the benefits against the inheritance tax charges. So over a long period of time, it could negate some of the benefits of the trust if the prime objective is inheritance tax planning. It normally means as well that there is a tax pool required within the trust, because the trust has to pay basically a 45% tax charge until on any growth until distributions are made out to beneficiaries, and then the beneficiaries can reclaim the difference between the 45% and their highest marginal rate. So the end result is the same, but obviously, again, it's impacting the growth within the trust, as it could be quite a period of time before the beneficiaries actually receive any benefits from the trust. Next slide, please. Thanks. So depending on where a client sits in their time of life, the thought of committing significant funds to a trust may be concerning, because, as I said before, they do lose access for their own personal benefit. So one option is a loan trust, which provides a nice middle ground between the two options. So as again, it suggests there is a loan rather than a gift into the trust. Because it's a loan, the original loan capital is deemed to be still part of the donor's estate, and therefore will permanently be considered as part of the estate for inheritance tax purposes. But any growth above and beyond that initial capital sum will be outside of the estate. So it's useful to help prevent estates from growing, but not necessarily mitigating current inheritance tax positions. But what can be done at any point is that the loan can be written off. If it's written off during the lifetime, then as long as the donor survives 7 years, then that will be outside the estate. It could also be written off on death. It would still form part of the estate, but it can be used, as said previously, to bypass probate and then be used to help pay any inheritance tax costs. And the next slide, please. So here we've got an example of a loan that's been set up. So normally this is set up for a client who has retired, wants to still generate an income or potential capital for their own purpose throughout their retirement, but also wants to incorporate some inheritance tax planning. So we'll go on to the reason why 5% has been used in this case, but a client here has invested 200,000, wants 5% income out of the trust every year, and that will be a tax deferred amount. So that can be 5% net. And as we can see there, over the course of time, the percentage amount within the trust that is of the remaining loan is reducing over time, starting at 100%, but reduces down to nil over 20 years. And gradually the growth, which is outside the estate for inheritance tax purposes, increases over that period of time. Now, obviously, the value of this would be only useful if the client was actually spending that 5%. It would have little advantage if they were taking money out of the trust and have it sitting on a bank account. So we do want that money to be spent as part of the client's normal expenditure to really benefit from the inheritance tax perspective. There are limitations, as we saw earlier. Realistically, trusts can normally only benefit up to a person's nil rate band of 325,000, or if they're married jointly, 650,000. So the benefits of trusts do get impacted above and beyond that. But there is this option here, the RISAF principle. So the background to this was a court case versus the RISAF trustees versus the Inland Revenue in 2003. And the Inland Revenue were basically saying because the RISAF trustees had set up a series of trusts on consecutive days, that they should be dealt with on a cumulative basis, and the inheritance tax charges should be applied as if they were just one trust. But the actual Inheritance Tax Act of 1984 has a couple of key fundamentals in it. The first of it is that if the settlor is the same in each case, and secondly, the trusts commence on the same day, then they would be deemed to be cumulative. But because these were set up on consecutive days, then each one effectively had its own nil rate band. And the HMRC lost the case, and we have it now set in law as a precedent that any trusts that are set up on consecutive days can effectively benefit from their own nil rate band. Please. So as an example, if somebody set up a trust for 500,000, one trust, they had one nil rate band of 325,000 applicable to it, then that would mean that there was an excess of 175,000, and there would be an initial lifetime tax charge of 35,000 on entry. And then on the first 10-year review, assuming that 325,000 nil rate band has gone up to 350,000, the calculation for that periodic 10-yearly charge would be a further £26,386. Whereas if using exactly the same numbers, but rather than it being one trust of 500,000, it was 4 separate trusts of 125,000 each on consecutive days, that wouldn't aid the initial lifetime charge. That would remain the same, but that would reduce the periodic charge by £8,690. So there would be significant benefit there by utilising this. Now, if we were using a loan trust, there wouldn't be a periodic charge, an initial charge, because the initial amount going in is basically still part of the estate. The only risk would be a periodic charge. And by using multiple trusts on consecutive days, then that periodic charge can be mitigated as well. So that's one way around utilising more capital, basically, or more assets within trusts to try and benefit and mitigate any lifetime implications. And the next slide, please. So trusts like ISAs and pensions are basically a tax regime. They're not a product in themselves. So any assets would have to sit within a vehicle. If we were looking at cash, we would be looking at an investment vehicle. So normally what would be utilised there would be an offshore investment bond. So the benefits of these is that because it's within a bond, the total tax rules around that are it falls outside of the capital gains tax regime. So any income and capital gains made within the bond are taxed purely as income. And because of its offshore status, then basically that can grow gross rather than have any tax implications on the underlying investments. So when we're talking about offshore, we're not talking about the Cayman Islands or anything like that. It's typically based in the Isle of Man or Dublin or Guernsey or Jersey. So it still falls within a very heavily regulated environment. So the key benefit is that it's not falling within capital gains tax, and therefore any changes to the underlying investments then can be made without any capital gains tax implications, and therefore that may prevent any investment decisions being made, because that could create a potential handbrake on that and affect the investment management, which is obviously not what we want to see under those circumstances. The 5% that we talked about on the loan trust graph, basically the HMRC rules allow for 5% per annum to be taken as a tax deferred repayment of the initial investment, which is why it's a useful vehicle for income, be it in trust or outside of a trust. So if we can go on to the next slide. Now, normally the bond will be set up into various segments. Most providers in the marketplace will break it down to 999 or even 9,999 different segments. And that will be still having the 5% tax deferred allowance available. But if somebody wanted to take out more than that and had a particular objective to pass that on to any beneficiary, they can surrender any number of segments and have it disposed of and assigned to a beneficiary that may have a lower tax regime or income tax applicable to them. So it can be to children, it can be to minors as well, for school fees planning, those sorts of things, and then they can benefit from their own personal no rate plans and also a lower income tax threshold. So that's one vehicle that can be used within that. So I think then it's over to James again to bring this all together.
Thank you, Marcus. Thank you. Well, how to summarise, and we've run over time a little bit, so I kind of want to get on to questions. But I suppose to summarise, I'd say that family investment companies are a popular choice for clients, perhaps increasingly so because of the changes to the trust regime all those years ago. They can replicate many of the features of a family trust, but without the inheritance tax charges. They provide some flexibility, and clients tend to understand companies, which is actually one of the reasons many of the companies we act for have been established. However, they're not always appropriate. Trust arrangements may often be preferred, particularly for less significant sums or where there's a more passive investment approach. So, as a sort of high level example, we did a bit of an exercise with a client 6 months or so ago, looking at a few £1 million, how to invest that with inheritance tax planning in mind. And we did a bit of an exercise comparing, well, what would be the total return, if you like, in a 10-year period if invested in a family investment company compared to say a loan trust of the type that Marcus explained. And on the basis that a loan trust could provide the inheritance tax advantages and flexibility in terms of being able to give away the loan or relieve the loan, actually in that case it was clear that the more straightforward loan trust arrangement was preferred. I think companies tend to be more suitable where we're talking about perhaps quite significant sums, or we want more diversity of investment, or the client wants to have more control and input and involvement in the investments. But in every case, it's important that bespoke advice is taken. And as a final point, I'd say that we haven't by any means covered today all of the options. There are other structures and other planning opportunities that may well be more appropriate. Again, highlighting the need for advice to be taken in every case. And on that note, let's bring this to a conclusion and hopefully answer some questions if there are any waiting for us. As I'm showing my screen, I can't see the questions, so hopefully Kat will be able to read some out if they're there.
Yep, we've had a few come through. So what is better in terms of reducing inheritance tax on a property that parents would like to pass on to a minor?
Right. So a single property that parents want to pass on to a minor, very unlikely to be thinking about companies. We may be considering a trust. Reason being, the property. I'm assuming here that we're not talking about the person's main residence, because we might advise against a transfer. But if it's just an investment property, it's possibly sat with an inherent capital gain. So a direct gift to minors, or perhaps to their trustees to hold for minors, will incur a capital gains tax liability, which may be undesirable or prohibitive. So we might advise that the property, depending on its value, is put onto, say, a discretionary trust for the minors, who are presumably children or grandchildren. The benefit in that case is that the capital gain can be held over. So the trustees, and in due course the beneficiaries, if and when the property is appointed out to them, essentially take on the historic base costs, so that any capital gain is deferred until such time as the beneficiaries sell the property. So that's an option. Again, bespoke advice needed, depends upon the circumstances, the type of property, the gain inherent in the property, whether there's any mortgage debt, etc., etc.
Thank you. Yep, so got a couple more. Is the rate of inheritance tax on a gift fixed no matter how long before death it occurs? So in the 7-year period, is it proportional if it's further away from death?
You're right. So the individual there is thinking about taper relief that applies to inheritance tax on failed, potentially exempt transfers. So let's take a step back. Someone makes a cash gift that remains in their estate essentially for inheritance tax purposes until they have survived the gift by 7 years. If they die between years 3 and 7, taper relief can apply to reduce the inheritance tax payable on that gift. So the normal inheritance tax rate is 40%. Effectively, taper relief applies to reduce the inheritance tax rate by 8% for every year between years 3 and 7 until it becomes tax-free after 7 years. Does that make sense, Kat?
Yep, thank you.
Okay.
If you have a joint-owned residential property that you want to put in trust, will the settler get nil rate band of 650 before paying the chargeable lifetime transfer?
Yes, essentially for inheritance tax purposes, it's treated as 2 trusts. So the trust settled by each settlor, each with its own nil rate band, provided each settlor hasn't made any other chargeable transfers in the previous 7 years.
So when setting up a family investment company, would there be issues converting an existing company into a family investment company by adding shareholders, or would you recommend setting up a new company from scratch?
Oh, depends entirely upon the circumstances. I mean, if we just have a dormant company that we're looking to use rather than set up a new one, just to save a bit of administration, then I don't really see why that should be a problem. If we've got an existing active company, then it may be possible to use that, but more likely I would suggest a new company would be required. Sounds like the sort of question that again depends heavily upon the circumstances of the individuals, who they want to benefit, what the existing company is doing and has done.
Yep, I've got another one, probably a bit more depending on the circumstances question, is what is the best way to mitigate IHT on a large family home with a value of 2 million plus?
Blimey. Large family homes, I take that to mean the sort of family's main residence. Very, very difficult to do inheritance tax planning with the main home because of the gift of reservation provisions. So, if I give away my main home but continue to live there without paying a market rent, then whilst it's not my asset legally, for inheritance tax purposes, the gift of reservation rules will deem it to be, and its value will remain in my estate for inheritance tax. I mean, to be honest, probably any planning with the main residence is the last thing we consider because of the difficulties associated with it. There is a potential planning opportunity where say parents and their children remain in occupation. So if a undivided share of the main residence is given to typically children, could be anyone who is in also in occupation, then the gift for reservation rules, broadly speaking, shouldn't apply on that gift. So you can potentially get a share of the value out of your estate for inheritance tax, but that does rely on the recipient being in occupation and remaining in occupation, crucially, to avoid the gift for reservation rules. Yeah, that's a very high-level summary of that. Further advice would be required, I think, in particular circumstances. Is that okay, Kat?
Yeah, there's obviously paying market rent as well, but that again, you have to be very careful and making sure it is market rent and reviewing it regularly, and you have to have the income to pay it, and the other person pays tax on it. So you say there's a couple of things to do, but they're very detailed and you need to be very careful with them.
One of the other options, sorry, cutting in there. One of the other options is obviously protecting the liability. Sometimes it's not practical or possible to mitigate the inheritance tax, and therefore protecting the liability, especially when you could be in that position where somebody has got a property worth 2-3+ million. It's all in one single asset. It's very difficult to try and mitigate. So depending on health circumstances and so on, Also, because it's all in one place, or all in bricks and mortar effectively, there aren't liquid assets to pay the IHT bill. So protecting the liability, put a life policy in place on joint life, second death in trust, will provide the lump sum required. And again, because it's in trust, it bypass probate, goes straight to beneficiaries to pay the tax bill.
Thanks, Marcus.
Yes, that's very important. If you can't mitigate it, you do need to work out how to finance it. Probably fit one more in. What are the tax implications of purchasing an investment property via a family investment company? Sorry.
Purchasing an investment property. I mean, we have a lot of clients that invest in property via investment companies. The tax implications of doing so. Well, on the acquisition, the company would typically pay stamp duty, land tax at the same rates as individuals, so assuming residential property rates plus the 3% supplement if it's residential property, provided it's going to be let out commercially, then the sort of higher rates that sometimes apply to corporate entities shouldn't apply. You need to consider ATED reporting every year. That's the annual tax on envelope dwellings, even though there's probably a relief that will prevent a charge. The rental income will be taxable in the company. The main rate of corporation tax is 25%. So if you're looking to receive the rental income of the company and then extract it all, you will end up with a higher effective tax rate overall on the income than if you receive the rental income personally. That is subject, of course, to how the purchase is funded, because a company should get relief for all of its mortgage interest costs at the main rate. So in other words, get full deduction, whereas an individual wouldn't necessarily. Blimey. The other thing, just sort of bear in mind with companies here, and this is just something that needs to be kind of mapped out from the outset, is that on the capital appreciation in value, the company, if the company goes and sells the property in 10 years' time at a profit, then the company will pay corporation tax at 25%. But then if we're also wanting to extract those funds from the company, there'll be extraction costs, either in the form of income tax if it's taken as dividend or other forms of income, or capital gains tax if the company is wound up at that point. So there's always this sort of potential double layer of taxation with a family investment company that in some way that can go some way to if you like, reversing the advantages that have been had potentially throughout the lifetime of the company. Does that make sense? I think the important thing is to kind of compare and contrast in each client's circumstances, I think. Does that make sense, Kat?
Yeah, I think it's all very case by case basis. It's not a one fits all at all. Definitely have to discuss it and decide what works best.
Yeah, I suppose the only other thing I would say here, if someone's looking to acquire a single investment property and perhaps that's it, or perhaps it might not expand significantly from that, then it's unlikely that a company is going to be the best advice, because it's just not significant enough. Yeah, I think that's probably the answer. Is there another one? Do you want to do another one before we go?
Yep. So I have seen family investment company used to make pension contributions for directors. Are there any issues with this?
That's a really good point, actually. I tried to, albeit I think I only touched upon it, bring that out in the talk. Let's just say someone has no earned income, okay, but the potential to make lots of investments or lots of investment income. They're heavily restricted on what they can contribute into a personal pension, because personal pension contributions in excess of 3,600 a year need to be franked by net relevant earnings, essentially earned income. On the other hand, if they make their investments via a family investment company, they are directors or employees of that company. So the company could make employer pension contributions for them, which do not need to be franked by personal earned income. So they could potentially put themselves in a position where they can contribute up to the annual allowance for tax relief pension contributions every year. It's currently £60,000 per annum, albeit that allowance is restricted for very high earners. The other thing to consider, whilst I would expect the contributions to be deductible for corporation tax purposes, they do need to be incurred wholly and exclusively for the purposes of the business of the company. So there's a risk, I suppose, that significant contributions might be met by a challenge in that regard from HMRC. But generally we don't see a challenge where contributions are paid on behalf of directors. What else to say there? It's possible, I suppose, to bring family members into the running of the company, either as directors or employees, and similarly that might allow the company to make contributions for them. Yeah, that's probably how I would answer that question. Again, dare I say it, case by case. So sorry to fall back on that answer again.
Yep. There's just one more in the chat, which you've sort of already covered with the previous question about the property and investment companies. Is there a point in transferring a property valued at 500,000 into a company when it's got a mortgage of 200,000?
Well, is there a point? Again, depends on the circumstances, but if there's no other activity going on, and just looking at how best to hold a single investment property, then simple answer is probably no. Where there's a mortgage, then putting aside the tax issues, you potentially have to refinance that, and that might in itself not be desirable. Stamp duty and capital gains tax on the transfer into the company is probably going to be applicable, and another reason probably not to transfer it. So probably my answer to that one is 99 times out of 100 it won't be advisable to transfer that property.
Thank you. So that's all we have in the chat, and we're 4 minutes over. So
Right. Well, thank you everyone for joining today. Obviously our details are on the screen there. Get in touch if you have any questions. I believe everyone who has signed up to today's webinar will receive an email with a link to a copy of the webinar and the slides. And yeah, thank you. Have a good day.